Welcome everyone. This is Dion Lisle, Director for 40 Grand. I'm here today to talk about just-in-time lending. We have two distinguished guests with us. I'll let them introduce themselves and then we'll get started to talk about lending.
My name is Shishir Singhania. I'm the Chief Lending Officer for Varo Bank. Varo is a digital bank based out of San Francisco, serving the American customers over here.
And I am Julapa Jagtiani. I'm a Senior Economic Advisor at the Federal Reserve Bank of Philadelphia. Been doing Fintech and policy work at the Federal Reserve Bank and around the system. So everything I say today, I have to remind you that it is my own view and not the views of the Federal Reserve Philadelphia, my employer, or the Federal Reserve System.
Okay. Good caveat. Thank you. So let's get started. One of the things we talked about in our pre-call was what is exactly just-in-time lending? Interestingly enough, none of us really had a great definition, but I think I'd love to hear, Shishir, what do you think of when you hear just-in-time lending?
Yeah, no, I think that's the fascinating question because when we were talking yesterday, I realized that there are many ways you can think about it. One way I think about just-in-time lending is lending, which is a lending decision and lending offer that's made to a consumer just in time and when they need it. So it's when they need it versus being made in a particular, offline manner. So for example, when you are looking to buy a big ticket item, at that instant, can you have access to lending that will allow you to buy the big ticket item? Second thing, which also goes into just-in-time lending, is are the lenders set up that they can underwrite and make credit decisions to make the offer instantaneously, right? So the example we talked about yesterday was if you want to buy a car and you're walking a lot and you want to know how much would that car cost you, the exact amount, is a lender able to give you that information while you're in the lot looking at the car? So there are two different ways to think about just-in-time lending.
How about you, Julapa? How do you think about the just-in-time lending definition?
Yes. When I see that title of this session, I thought of a few different different scenarios. One is for consumer, could be small consumer who may be getting paid. Like if I get paid every Friday, and my rent is due on the 31st, and it's 31st. It turns out to be Wednesday or Thursday, and so it would be nice to have the cash advance just a few days before my paycheck, and so that's kind of just in time for consumers, for mostly under. And I think some of the digital banks and fintech lenders are doing that now. Varo is one of them. Also, similar to auto loans that Shisha mentioned, like when you're looking at a house and you really love the home and you don't know if you're going to be able to get enough loan to pay for the house, you can just basically your information, and in 10 minutes you know how much loan you can get and what the rate would be. That's just in time, in my view. And for business, it's really just PPP.
Yeah, I think a lot of the definition comes down to the type of transaction, right? I mean, a mortgage just-in-time lending versus a car versus, and I know we've all seen the press releases and the funding around BNPL, buy now, pay later, to the point where I'm waiting for Starbucks to do buy now, pay later, like everything seems to have this instant option for buy now, pay later. I'm not sure I get it because I still think it's just debt. And I'm sure we would all agree we want consumers to be responsible for their debt, but also have the flexibility. So as I look at these subsets, I also think about the friction. Let's talk about friction. How much friction should there be on lending? Is just in time mean instant, or does it mean the best available for that type of transaction? What do you think from a regulatory standpoint, Julapa, on that?
Okay, so for lending, friction is when I hear friction, I first think of payment, right? That real-time payment. If you have to pay big fees and it takes a delay. If I want to send money to my mom as a birthday present, $50 in Bangkok, It could take a few days, and I would have to pay $25 fee. That's payment. But for banking, I would say I think of overdraft fees or some hidden fees that consumers don't even know, like this in the fine print that most people don't read. And I think that's friction is transparency, hidden fee that we as a regulator, we try to make that clear to consumers, educating consumer, but also disclosure from the lender's viewpoint.
How about you, Shishir? What do you think when I say friction in lending? Could it be a good thing? Should loans be instant? And is that what we mean by just in time?
Yeah, I mean, when I hear the word friction, for me, friction is never good. Now, that doesn't mean
Okay.
we do lending in an irresponsible manner. So, for the example that Julapa you had, uh, transparency is non-negotiable, right? We need to make sure that as we are lending to our customers, we are responsible and very transparent to them around the cost, right? So one of the things I'm very proud about Varo is when we have our banking accounts that we offer our consumers, we don't have overdraft fees because most of the customers who pay overdraft fees at big banks are customers who don't have access to a lot of funds, and that's a $29 $35 fee is a pretty big number for them. So we don't have that, and we tell our customers we don't. um, but coming back to your point of friction, I think I would separate out friction from responsible lending, right? I always say lending is an irreversible decision. It's very easy to give out money. It's very difficult to get the money back from a responsibility perspective. So we need to do what we need to do to make sure we feel comfortable with the with with the credit decision of making that lending decision, and also we're doing it in a responsible fashion, so we're not putting the customer in a bad situation. So those two things are incredibly important to do. We also need to make sure we are doing everything we need to do from a regulatory perspective, so we know who our customers are, and we are again, making the decision, knowing and do our KYC and all of those things. But none of those for me are
And,
friction, right? Those are things we got to do to make responsible decisions. They're not friction. We can do that in a way that it doesn't delay the lending decision. It doesn't come in the way of the lending decision. For me, friction is you know uh, taking the customer out of whatever they're doing, so they spend an unnecessary amount of time to get that loan. So, for example, I love the example again you had about giving some of our customers access to their paycheck a couple of days early because their paycheck fell on a Friday and their rent was due a couple of days before. You can do it in a couple of two different ways. You can do it where you ask the customers for a lot of information about their you know about their personal information, about their income and expenditures before you make that loan. Or you can set it up where you use the information you already have about the customer, and you're able to make that lending decision almost instantaneously. So when the customer is on your app, and most customers are using a banking app these days, so that's not unusual. In literally a couple of seconds, you're able to get the money over to the customer and help kind of help them out in terms of the cash flows. And the transparency piece also comes in it's a key piece because there are ways you can make instantaneous decisions but not be very transparent with the fees that are associated with it. And there are ways you can make the decision while being very transparent with the fees so the customers knows what they're getting into. So I think that's where friction, making responsible lending decision and being transparent with the decisions all comes together for me. But friction in itself is a bad thing. I don't think that means you make bad decisions.
so interesting. Just today, a point you made come across my, my news feed, which is Klarna, BNPL company out of Sweden. Losses have soared because, and Ron Shevlin of Snark Tank made the excellent point that you just made, which is it's easy to give out money, a lot harder to get it back. So as people begin to use these BNPL, particularly, the one that strikes me is everyone thinks, oh, it's some guy or gal buying a Peloton, 4 easy payments. Wow, that's awesome. But now that BNPLs are available across so many consumer goods, is it reaching a point where maybe it's less responsible than it was? Certainly, Klarna's losses would indicate that's the case. So for you, Julapa, from a regulatory standpoint, is that something where a regulator is going to step in and look at these loss rates and begin to require more disclosures, or my word, friction? Shishir doesn't like the word friction because it has a negative connotation for sure. But should lending slow down because of that?
Okay. First of all, these fintech firms are not under the federal radar screen. So unless they partner with banks, we don't regulate them. But if we are starting to actually get more and more involved with fintech, only in the sense that they are partnering or providing service to the banks that we supervise, just to make sure that it's all in. So loss to fintech firms is not our concern, but I think the way that there's all interaction, right? Everything is all related. Now we know that when the subprime crisis started, we didn't think that it would become a global problem, and it. So it's the same here, and I think it is important, and I think fintech lenders are generally doing that, is to even for people who don't have a FICO score, people who actually don't have enough money to pay for a laundry machine, but they need it because it just broke. And so that actually, a lot of this previous relationship through payment platforms, and so like talk to some of the BNPL firms, that they start with very small amount. But if they have consumer data on previous payment, and you can, it is unbelievable if you understand how so much information has been collected about consumers, from your phone, from your credit card payment, from which join, and your network, what time you get up. Sometimes I heard. So it's like it's everywhere, and so if some lenders information and able to utilize it in their credit decision. I have done work myself looking at not this network or what time you get up, but really more solid alternative data with more complex modeling. And I find that this credit decision actually is better, much better than FICO score in terms of ability to predict default on consumers for personal loans. Yeah, so not yet. We're not regulating BNPL yet, but as soon as they partner with banks, they become third party vendors. We start working to look into what they're doing, to understand what's inside the black box too.
Yeah, that's really helpful clarification. I didn't realize it worked that way. And certainly a lot of banks are looking to partner and or deliver BNPL for their customers. And then at that point, under your purview, that makes a lot of sense. The other thing we talked about yesterday, and I want to dig into, is in order for this real-time, just-in-time, fast lending, you have to be on a digital platform. And I work a lot with community banks as the managing partner of 40 Grand. And I find a lot of community banks are still doing with a person. Like half the process is just a person. What's your thought? And now, Shishir, you're at a digital only bank. You started digital. Do you think you could do just-in-time lending unless you're an absolute digital platform? And the other piece of that is when you're a digital platform and there's a nuance or a mistake, how do you prevent the velocity of that putting out a lot of bad loans or being difficult to control?
Yes, so maybe let me take a shot at that, Dion. So I think you're right. I think for any lender to do just-in-time lending at scale, being on a digital platform is incredibly important. I don't think being on a digital platform means you have to make not good credit decisions. I think you can make as good, if not better, credit decision being on a digital platform, because you take a lot of judgmental decisioning out of the system, but you have to invest in understanding the customers, understanding the data, to the point that was made earlier. Not all customers you can't use a standardized FICO score for all customers. You have to be thoughtful and creative about how are you making those decisions. I'll give you an analogy on your question on velocity and how do you prevent a decision from a bad decision from scaling up and putting a lot of loans on your platform. One of my mentors, as kind of I spend time on lending, described non-digital lending as, say, driving a old, and I'll use an analogy here, and so forgive me a little bit on that one, but like driving a old Honda Civic from the 70s or 80s on a road, and you really enjoy it. You're used to it. It's a very comfortable car. You love it. Now, if somebody says, no, 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 let's put the engine of a Ferrari and let's go fast and make it digital and go all the way at massive, like 200 miles an hour, you can't do that. I mean, you can put the engine in, you can't stop the car, and if something goes wrong, it's going to be disaster, right? So, but if you want to drive like a Ferrari, you have to get the brakes in, you have to get all the systems in so the car can adapt to that speed and react to changes in the marketplace, right? So, what I mean over there is as you scale up and as you put digital systems in, you have to put controls and monitoring in place so you know at any point of time what decisions you're making, the impact of the decisions, and the quality of the decisions. And you have to build in a structure that allows you to react to those and make changes, right? The challenge is no different, right? Even if you're doing uh, manual underwriting and you're making bad decisions, you need to have a framework to monitor and react to those changes, to those decisions. With just in time, you just need to have a much more robust framework, a just in time monitoring framework, if you may.
That's great. No, good answer to that.
And
And speaking of that technology basis, AI, Jalapa, I know yesterday you talked about you guys are looking at the ethics of AI and kind of the impact and all of that. I found that kind of fascinating, Jalapa. I'd love to hear more about how you look at this automated decisioning, whether it be AI or otherwise.
sure, yeah, I'll talk about it. But may I add something to what you just asked earlier? So for there are some lenders who actually these loans BNPL generally are very short-term loans, right? And there are also a lot of loans that are like payday loans or even a little bit fintech loans. Some of them are only for 30 days or 60 days, and it's really useful for people who need to pay for emergency room or things like that, right? It's very important, and that is just in time lending. And these lenders may be charging, say, $400. You pay $40 fee or something like that, and which is like for a month or two, which sounds okay, but sometimes it's APR. If people cannot get out of this, cannot make the payment and keep going back to get these loans and keep paying the same rate, it becomes over 100 or 200% APR. So that's one thing, that's one friction that I was going to mention. But also, these lenders may feel comfortable that because they feel that they could adjust their balance sheet very easily because their loan is so short term, 30 days and 60 days, and so there wouldn't be a problem. Usually it's that's the case. And when the pandemic come, this time when overnight everything got locked down, that's when some of the lenders actually went under because they just couldn't adjust overnight. They could adjust in 30 or 60 days. So that's one thing I would like to add. And in terms of AI, yes, we regulators are working because a lot of partnership, and it's the distinction between traditional lenders and fintech lenders getting blur over the years because this is clearly the way to go. We can't do without the technology. It's become necessity. There's all kinds of partnership, and banks also are using fintech, and to develop their own internal system, it takes a lot longer because of the legacy system that banks are using now. You know better than me. Uh, so a lot of partnership, a lot of vendors relationship, and so sometimes don't even understand how they make that credit decision because the black box tells them from the vendors that that's what they should do. and that the vendor was using AI. So we are trying to make sure that banks that we supervise understand how they make their credit decision, understand what's inside the black box. And sometimes the model may be okay, but if the data, some of the bias may be embedded in the data they use that enter the model. So that could be a problem. So we are working on this AI guidance at the Federal Reserve. I joined with other agencies, FDICC as well. So AI usage, also separately, third-party vendor risk is another guidance that is coming out to make sure that banks fully understand the vendors, and if necessary, it's going to be difficult. Say all the data is kept on the cloud, and do we need to go examine Amazon or Google because they have all the bank and how secure it is? So it's a little bit difficult, but it's we are working on it now.
Yeah, no, by the way, good segue there onto the technology platform. And I often bill myself as the Rosetta Stone between legacy bank and fintech startups for all the reasons that you're talking about, which is there's this real difficulty for the legacy banks to understand the technology. And I'm sure we all saw the same stories I did when PPP lending hit. All of a sudden, the New Jersey Unemployment Agency had to pay COBOL coders like thousands of dollars an hour because all their stuff was in COBOL. They had to connect to an API. They didn't even know how. And so these technology differences really become inherent. Shishir, you were in both a traditional lender, Cap One, I think you were at, and now you're at a digital only bank. What do you think the technology difference is? And I always have to lead off with this great Silicon Valley joke, which is, how did God build the world in 7 days? He had no installed base, right? So when you're at a Capital One and you have this big installed base and you have to bring them along as compared to Varo, where you're able to blank sheet of paper innovate, how do you manage that balance?
Yeah, I think that's a great question. Look, the the massive advantage we have at Varo compared to any traditional bank is what you said. We have built a brand new, our entire solution on a brand new technology stack, which is modern, which is very adaptive, which doesn't have any legacy system that slow it down. It just allows us to innovate fairly quickly and to scale up, right? We don't have branches. So if you want to add one customer or a million customers, the effort is fairly low in both the cases. Now, more and more of the traditional banks are going to try and move in this direction because that is a need that the customers will have because they expect that kind of a service from the banks. But to your point, the legacy systems are not easy to transfer and transition, and it becomes a long journey for them. It becomes a journey that is expensive, and it's also a journey that requires patience on their end from their customers and some friction, to your point earlier, as they make the move. But because for a bank like Varo, because this is how we're built, this is how we think. It's essentially a tech company, building quickly and scaling up quickly without the legacy systems that we have to deal with. It's a huge
Yeah, that
advantage,
makes
and
a
it's
lot
an
of sense.
advantage that I think is starting to play out in the market now.
Yeah. Let's shift for a minute here. Uh, Privacy. How do regulators look at that? I mean, we read about a data breach, seems like every day, every week at least. And what do regulators look at? How to protect privacy? I mean, yeah, we need data, better context, all of this to make these lending decisions. And yet we're exposing somebody's personal data in that process. How do the regulators look at that?
It is very difficult. Know that everyone is collecting consumer data now. Google has so much information. Apple, Facebook, everyone is collecting data, and actually, all the financial services providers, I would say, a lot of vendors to for identity and for cyber for their own protection, but from what I heard, it's one of the vendors, right? Every time you log into this one of the 25,000 or 60,000 websites, they collect 800 variables about you. So actually, they know so much about you, and they actually pretty much your life is in someone else's hands. So that is, we are concerned because our roles is to protect consumer privacy. So that's why we have this open banking and GDPR. The intention is to try to give consumer more control over their own data, because actually once the data, this big tech or other firms your data, you don't even know what's in their hands and when they're going to use it and how they would use it and for what purpose. So it would be trying to give people more control over their own personal data as much as we can. It's a tough process. We're working. Does that answer your
So
question?
Shishir, how does yeah, perfectly. So Shishir, I'm sure Varo has a lot of programs in place to protect users' personal data. Can you talk a little bit about your program or your systems that protect a user's data when they're a Varo customer?
Uh, well, I think so. Two things. So one, I think I will be overstepping my knowledge if I talk about exactly how Varo goes about protecting the data. But I do know from our executive focus, ensuring that we took very good care of our customers' data is top priority for us. Like we are a chartered bank. We disproportionately care about customer data. Trust is so important for a bank, and it is the data is out there as we just mentioned, but it is extremely important for us to make sure that we are treating the data carefully, and we're also being very transparent with the customer on when and how we are using the data, so there's no surprises for the customer.
You made the point earlier, Shishir, and I think it's a good one worth repeating, and I hope other banks are listening. Transparency, right? Be transparent with your users about their data, where it's protected, and so on. But I get your point about not wanting to let secrets out, for sure. When I was with a large bank, we had found out that one of our sub vendors was actually selling our system code to nefarious actors, and there's so many potential leak points in a large complex organization like a bank that you really have to be diligent, and it sounds like Varo is doing a great job at that. So then the other thing I think of when I think of personal data is KYC AML, right? How do you vet? How do you make sure that they're good actors on your platform? And I know regulators look at this all the time, but first I'll go with Shishir. Varo has a KYC AML process. How do you make sure that you're not getting false positives, putting people out that should be in, and just making sure you're balancing that need for good KYC AML, but also opening up your platform to many people?
Yeah, I think that's a great question. I mean, you know, one of our mission at Varo is to have financial inclusion for all, right? So as we're building our KYC ML processes, we are working with partners across the industry and other fintech partners who have developed new tools and systems to allow us to do KYC ML at scale for a much wider set of population. And to your point around friction, this is again one of those non-negotiable things. Like we have to do this, and we have to do this right. As we open accounts, as we give more lending products to our customers, this I don't see it as a friction point, but I see that this as a hygiene factor that has to take place for any banking relationship. But what we try to do is ensure we use the latest and the best tools that are out there and partner with firms who are experts at this to execute on KYC.
Perfect. How about you, Julapa? Do you look at the KYC AML field of play and think different now, or is it just always top of mind in your type of organization?
It is actually, yes, we always have some team experts to focus on KYC AML when they go examine financial institutions that we supervise. I mentioned a false positive, and that's so true that a lot of resources went into in the past, a lot of false positive and wasting. So it's nice that now that machine learning, actually a lot of firms are using AI ML that help to reduce significantly the false positive. So that's more efficient for banks, but that doesn't mean that they're able to capture more cases. In terms of regulating this KYC AML, the banking industry, things have changed. The whole entire has changed now that with cryptocurrency, for example, digital crypto. So the current landscape, the current not exactly the way it was when we designed these guidelines and regulations. So things we are working on, we have to adapt. Regulators have to adapt as.
Yeah, that makes sense. So to that point, and let's start to wrap it up here with this question, which is, so Shishir, now pandemic lasted longer than any of us expected. Do you look at decisioning for lending different now than you did at the beginning of the pandemic? Has this time in the last, can't believe it's a year and a half, 2 years, has it changed how you at Varo look at lending decisioning?
I think absolutely. The interesting thing about lending decisioning is you're typically looking in your rearview mirror to understand how to make a lending decision for something in the future, right? So as we got into the pandemic, your rearview mirror didn't have any information around how customers would behave in a pandemic, how would the credit situation change through the pandemic. So most companies, became more conservative in terms of how they were making lending decisions given the uncertainty. Now, given that we are a year and a half into the pandemic, I think you have a lot more data, you have a lot more information. You also know how different customers have been impacted by the pandemic. You know how different programs that the government has had an impact on customers' cash flows and things like that. So your lending decisions are becoming better, especially when you talk about the shorter term decisions, the shorter term lending decisions versus say longer term lending decisions. So yes, so the decisioning has changed. The data we have access to make those decisioning has changed, and in a much better fashion. And I expect it to continue to evolve and change over time, right? You saw a lot of that also reflected in how, if you just look outside of banking and lending, but if you look at how the markets reacted when we, went into the pandemics, there's a huge swing up and down because of that uncertainty. Which again, because nobody knew what to look at from a historical data to forecast how things would play out, and it's just true. Same thing is true for lending as well. But I have to again say, uh, because you're looking in the rear view mirror when you're making a lending decision, it's not just about, the rear view mirror never tells you exactly what's going to happen in the future. So you have to build the muscle to peek around the corner, to know what are the potential outcomes that can happen in the future and plan for that as you're making your decision.
That's well said. I often use that rearview mirror analogy myself in helping banks to understand how they need to innovate. And speaking of that, let's wrap up with Jalapa. How do you look at regulatory now versus at the beginning of the pandemic? And has it changed how you're evaluating auditing banks?
Sure. Obviously, the pandemic has changed everything, and the level of digitization occurred it just in the last year or so. Could have taken 7 years, from people said, because even from both the bankers side, the lender side, and consumer side, consumers, a lot of them don't even believe in digital signature, right? And so with the pandemic came in, it would have taken 5 more years to convince them, but it only took weeks for them to move along with that digital signature. Again, so then for banks, there would be less branches. There'll be a lot of digital transactions. Deposits are different now because we actually, in the old time, we collect where deposit, which branch deposit goes to. And now banks actually, it can go to this branch and then actually it's recorded in a totally different state. And a lot of banks don't even have a branch. Like Varo is an example. You don't know where the bank is. So it is, yes, the way we regulate, the way we do things, it would be very different. And CRA, compliance, as community reinvestment. We used to look at it the old way, where, well, if you take deposit from local customers, you should pay it back to the same community. But now, because banks don't have location, they don't have physical location, how do you measure their payback, paying forward? So that's one thing that, yes, it has to change. And in fact, we are revising our CRA guidance because of all this. Another thing is, you mentioned the rear view mirror. Definitely, when you look at rating, FICO or Vantage score, particularly earlier, not now they're trying to adapt, but it's based on your previous default, right? So if you already default, your score declines. But if you want to look forward, if someone just got divorced or just got sick, it's not reflected in your FICO score. But alternative data would tell you that. So if you stop getting salary coming into your bank account, or you're paying for, sometimes some people say, well, if you pay for lawyers, marriage counseling or something, then it's actually, that's kind of invasive, consumer privacy. But a lot of additional data actually is now being used. We have to be careful that we are using the right type of data and protect consumer. But it's changing now. Even FICO now is allowing some consumers to offer alternative data, like rent payments or utility payments on top of that, just to boost that score. So it is changing. And so, of course, we have to adapt with the entire landscape as a regulator.
That makes sense. That's a really good. We'll close on that. And I just found out recently that rent payments were not part of your FICO score unless you went outside the lines to make sure. And I think that alternative data you talk about, I think that's key. Well, we're going to wrap up here. Thank you for joining us. Shishir, Julapa, thank you so much for your insights into this rapidly changing landscape. Appreciate everyone's time. Hope you enjoyed this, and look forward to hearing more from Varo and the Fed in the coming weeks and months as we all figure out what the future holds. Thanks again for joining, everyone.
Thanks for
Awesome.
having me.
Thank you.